Good evening, everyone. Yeah, great. So we'll start the presentation or the lecture today. Right now is related to financial systems, banking, and the stock exchanges as they operate in our country. Now, the idea of this lecture is to give you a basic foundation or basic understanding of these aspects. We will try not to go into too much of detail. The idea is to equip you with enough knowledge so that you can handle any group discussion, any interview related questions, and also to make you capable of reading and understanding the newspapers or the articles or the current affairs related to these sectors. Yeah. So as far as the financial system of our country is concerned, it is a very wide-ranging aspect of our economy. It includes financial markets, which includes primary market and the secondary market as well, right? We'll be covering these in detail later. We have various financial institutions like banks, insurance companies, regulatory institutions like SEBI and RBI, right? And various financial instruments like P-notes, promissory notes, treasury bills, stocks, bonds, etc. These also we'll be covering during our lecture. And various financial services also, which are being provided by various companies and institutions like insurance, merchant banking, etc. These also we'll be covering as part of this lecture. Right? All the components are regulated by specific regulators. For example, capital market is being regulated by SEBI, and then money market is being regulated by the Reserve Bank of India. Right. So covering the first component of financial system in the country. First one is, of course, financial markets. There are two types of financial markets. Basically, what we are dealing with is money markets. This is for short term, that is any loan which has a maturity of which is less than 1 year. Any loan with a maturity which is less than 1 year is called a short term debt. Right? Capital market is long term, that is anything with a maturity or a period which is greater than 1 year. Right? And equity also, it deals with equity as well as debt. So debt is naturally the loans which are required by individuals and corporations and the government as well. Equity represents a sense of ownership of a particular company. Right? So if you are owning, let us say, 100 shares of Reliance, then that 100 shares represent the equity, and that represents a fraction of ownership of the company as such, right? And there are two segments of financial markets. Primary markets, they deal with new, fresh or initial issues. That is when a company is putting its shares in the market, selling it to retail investors or institutional investors as well for the very first time, right? When the company sells to investors, it is sold in the primary market. When the shares which have been sold in the primary market is traded, let us say, on the stock exchanges, that particular market is known as a secondary market. Right. So, what are the various financial institutions that we have in the country? Bank, insurance companies, mutual fund companies. Individual investors, industrial investors, and trading companies are the borrowers from these companies as well. Now, these financial institutions are generating sources where the savings by the community can be made. They're providing a source where surplus funds of individuals and companies can be saved. They are providing an avenue of mobilization of savings. So For example, if there are less number of banks in a country, so most of the people would keep their surplus or savings hidden within their houses, right? So these financial institutions are providing a channel for these savings to be used within the economy and contribute to the economic development of the country. Financial institutions are also helping in effective distribution of savings. Now, various savers may be geographically scattered, right? What these institutions like banks, what they are doing is bringing the savings of geographically scattered individuals into a single pool, right? And out of this single pool, this money can be given out as loans and credit to industries, again individuals and government as well. So what are the various financial assets and instruments? They are also enabling the channelization of funds, as we understood in the previous slide. So various instruments are deposits, equities, mutual funds units. For borrowers, we have loans, overdraft, etc. For business, governments also, in order to raise funds, they can issue bonds and treasury bills as well. Further, we have PPF or KVP, Kisan Vikas Patra, available to savers who wish to lend money to the government or and earn interest out of it. So the various financial services that are being provided by financial institutions, of course, we have borrowing and funding, lending and investing, buying and selling of securities. This is being provided by financial brokers or stock brokers, payments and settlements, managing risk exposures. For example, it is being done by mutual funds, which we'll be covering later in greater detail. Other examples of financial services are credit rating. These are companies which are rating the credit worthiness of different companies. These credit ratings are used by banks to decide the interest rates at which loans are to be extended to various corporates. Yeah. So let us try and understand the very basics of what is banking as such is all about. Yeah. So it's a business activity, first of all, right? Wherein there is acceptance and safeguarding of money owned by other individuals and entities, and then lending out this money in order to earn a profit, right? So banks are working like any other companies. They are working to earn more and more profit out of their operations. Now we look at the various functions that a bank is providing within the economy. Functions can be broadly classified under primary functions, and then what we have are secondary functions. So primary functions, we have accepting of deposits by the banks. Of course, this is done through savings banks, fixed deposit banks, FDs, current deposit banks, accounts, and recurring deposit accounts. Further, accepting deposits and granting loans. This can be done by credit, like any other loan, car loan, home loan, etc. Bank overdraft, wherein a bank provides a credit which is beyond the money which is there actually in your bank account. Loans, and then bill discounting. Yeah. So secondary functions which the banks are also providing for various customers. Again, we have fund transfers. This can be physical or online as well, right? Check collection, payment collection, portfolio management. This is where qualified managers handle your investments in stock markets or bond markets, etc. That is known as portfolio management, right? Other utility functions that the banks are providing and charge a fees for is issue of draft, letter of credit, locker facilities, underwriting of shares. Now this is when any company wants to release its shares in the economy and raise funds in terms of equity. So the administrative work, the paperwork which is necessarily required, these services are also provided by banks. These kind of services is known as underwriting of shares. And then what we have is foreign exchange. Of course, if you have to travel abroad, if you need US dollars, pounds, etc., you go to a bank and they also charge a bit of commission on this. Banks also make project reports for various projects. Portfolio management, Arpan, is when banks are investing funds on your behalf. These funds can be invested in stock markets by buying of shares, right? Or bonds as well. Right? So banks are also involved in certain social welfare programs, which are certain social welfare programs which the government of India or the RBI directs it to function. The most relevant or most current example is obviously the Pradhan Mantri Jan Dhan Yojana. Yeah, so various types of deposits that we have or accounts that we have. Yeah, Piyush, these companies are also, there are specific companies like RV, of course, which are providing underwriting of shares, but there are certain banks also which are providing these services. Yeah, so we have the basic account which is most common in our country, that is the savings deposit accounts, right? And then what we have is current deposit account. Current deposit accounts is used by businessmen in order to who have a lot of transactions as far as payment or receiving payment is concerned. So usually what happens is this is a highly liquid account, right? There's a highly liquid account, that is any number of transactions can be made and no fees would be charged for any current deposit holder. In the case of current deposit account, there is no interest rate which is given by the banks. Of course, for saving deposit account, the banks are providing interest rates ranging from 4 to 6%. Right? Then what we have are recurring deposit accounts. These are accounts which are opened in order to promote regular savings. So what happens is any individual with an RD or recurring deposit account deposits, let us say 5,000 or 10,000 rupees per month in this particular account, right? These are also fixed terms of maturity, let us say 10 years, right? After which the person can withdraw money from this account. Again, very common account is an FD or a fixed deposit account. The only difference between our recurring deposit and fixed deposit account is, in the case of fixed deposit accounts, the money which is to be saved is put in the account initially. The entire amount is put in the account initially. In the case of recurring deposit account, the amount is obviously paid monthly or weekly or as the case may be. And there, of course, since 2005, RBI has allowed no-frills accounts. That means the account holder can put. Arpan, usually RD and interest rates for recurring deposits and fixed deposit accounts are usually equal. They can range from 8 to 10% depending on the bank. It is entirely the bank's decision what the amount of interest rate that it wants to pay for these accounts. Right. So next what we have are no-frill accounts. In this case, the holder of the account can maintain a zero balance. He will not be charged any fees or fine for it. Also, other services related to a normal account, let us say net banking services, debit card, credit card, etc. These are not provided as far as no-frills accounts are concerned. Again, in Jan Dhan Yojana as well, these are the type of accounts which are being opened for everyone. So now let us try to get an overview of what is the banking industry in the country is like. So RBI is the central bank, of course. Okay, I'll just repeat it again. No-frills account. No-frills account is a basic account which is being opened for people specifically being targeted for financial inclusion program, right? So these are accounts for which no other services like net banking and debit or credit card is being provided. Oh yes, of course, the Rupee debit card is being given by Jan Dhan Yojana. No, the Jan Dhan Yojana, this is not a regular no-frills account. Right. So moving forward to an overview of banking sector in India. Now RBI is a central bank. It is governing all the operations of banks. For example, it is deciding the repo rate, reverse repo rate, various regulatory checks. For example, SLR, CRR, etc. That is what RBI is deciding. So RBI is the central authority as far as banking in India is concerned. So what we also witnessed in 1969 that there were a large number of private banks which were going through a period of crisis, right? So in order to get these banks out of that crisis, and in order to align these banks to fulfill national objectives, we had nationalization of banks, or the government bought these banks from private owners. First of all, in 1969, 14 banks were nationalized, right? And in 1990 again, 6 banks were nationalized. These are the various services which the banks are providing in India. Retail banking for individual users like us, business banking for business owners, private banking and investment banking. Now we go to types of banks in India. Just a brief background about Reserve Bank of India. So it was established under the RBI Act of 1934. It started functioning in 1935. Main functions are, it is a monetary authority of India. That is, it controls money supply in the economy by using its policy rates, namely repo rate and reverse repo rate. It regulates and supervises the financial system of the country, right? So it is providing certain rules and regulation by which the on the basis of which banks and other companies like non-banking financial corporations, NBFCs, are functioning. So RBI is the main authority for that as well. It is managing our foreign exchange or forex reserves. The forex reserve of India is being held by the RBI or controlled by the RBI, right? It also manages foreign exchange by using this act known as FEMA, Foreign Exchange Management Act of 1999, right? Also, RBI is the main authority of issuing the currency as far as your notes are concerned. It is also the sole authority to destroy currency which is soiled or maybe outdated. So currently RBI is in the process of decommissioning all the notes, all the currency notes which have been printed before 2005, right? So RBI is the sole authority as far as issuer of currency is concerned, and RBI is also providing a developmental role. For example, a local area bank scheme which was started by RBI. This scheme will be covering later in the slide as well. Yeah. So, moving on with the types of banks in India. First, we covered the central bank, that is the RBI. Second category of banks is the commercial banks. Right? These are obviously profit-seeking institutions which are accepting deposits from general public and give out advances or loans to individuals or companies as well. Their main source of income is the differential between rates they charge to borrowers and pay to depositors. Right? That differential in technical terms is known as the spread. So their profit comes from this particular spread between what they are charging from borrowers and in fact paying back to the depositors. Operations, as we see, that are controlled by RBI. The classification of commercial banks, as far as classification of commercial banks is, there are basically two types: scheduled banks and non-scheduled banks, right? Non-scheduled banks, we do not have any non-scheduled bank as far as our nation is concerned. Last non-scheduled bank was closed in 1990s sometime. So all the banks are scheduled banks within the country. So these are foreign banks. RRB is regional rural banks, right? They are catering basically to the rural economy. Then of course private sector banks and the public sector banks. Yeah, as I mentioned earlier, there's this urban non-scheduled banks were banks which were not registered or included in the RBI Act of 1934, right? So the major difference between them were they had less amount of regulatory control as far as RBI's control on these banks was lesser. The CRR requirement, for example, while scheduled banks have to keep the CRR amount with the RBI, the non-scheduled banks had to maintain CRR, yes, but they had to maintain it with themselves only and not with the RBI. However, there is no non-scheduled banks which is existing in India as of now, right? Yeah. So local area bank scheme was started by RBI. It was to promote banking facilities in local areas. These banks were restricted to operate maximum in 3 districts. So all the financial needs, all loans, all credit, etc. of of 3 districts were to be taken care of by a particular bank, which was a local area bank. It's mainly targeted at agricultural requirements and extended code loan facilities, etc. However, this particular scheme was not highly successful, and most of these banks have closed. Only 3 or 4 remain now. Yeah. So next category of banks what we have in India are cooperative banks. These are registered under a particular state in which they are functioning. They are generally covering the needs of rural sector and particularly the credit needs of agriculture sector as well. They are providing short term and medium term credit to agriculture specifically. They are further categorized into 3 categories. They operate at state level, operate at central level as well, and then local level as well. Another category of banks which is existing in India are development banks. So these are development oriented banks. They are seeking to promote investments in specific sectors of the economy. So for example, we have for industrial development, we have these banks IDBI, IFCI, ICICI earlier, and IIBI as well. Further, taking care of the credit needs of small scale industries is a bank, developmental bank known as SIDBI, right? Exim Bank is specifically targeting the credit needs of importers and exporters especially, exporters or traders within our country. As far as Agriculture Development Bank are concerned, NABARD is the central authority for agricultural development, right? And then what we have are banks at the state level and local level as well. Yeah. So this is a new type of bank which is being which was actually proposed by the Urjit Patel Committee. This was Urjit Patel Committee. This was set up by RBI in 2013, right? So he suggested that a new type of bank needs to be created, which is known as the payment bank. So RBI has given guidelines in 2014, and such banks licenses are to be soon given. The main difference is that entry capital requirement for these banks is around 50 crores. For other regular banks, it is around 500 crores, right? So these banks cannot lend, and various NBFCs, corporates, telecom companies, retailers, etc., can apply for license for opening a payment bank. The basic idea of a payment bank is it will be entirely based on electronic or mobile based funds transfer. So if there is a migrant worker from Bihar who is working in Punjab, right? So he can easily send the money by using his mobile phone. These kind of services are basically will be provided by payment banks. So basically they are focusing on remittances, that is domestic remittances within the country. Now we try and understand how does RBI control the monetary policy or the money supply within the country, and what is it exactly used for? Yeah. So monetary policy is a policy which is used by RBI to control the amount of money which is existing in the economy. Various tools available with it are, we'll be covering these in detail later, CRR, SLR, and these ones. Various tools which are available with RBI for controlling monetary policy is, first one is the base rate, right? So base rate is a reference rate which is different for every bank. Each bank calculates it, right? And but banks are not allowed to charge interest rates below the base rate on any loan. So a bank would provide a loan, let us say, at an interest of base rate plus 2%, right? So the interest rate being charged by the bank to any customer cannot fall below this, cannot fall below the base rate, right? Bank rate is another tool. It is a rate at which RBI lends to banks. These figures are slightly outdated. You may check these figures or on the RBI site itself. Another tool of monetary policy that the RBI has is it. No, Varun, bank rate is different from the repo rate. Repo rate is basically dealing with the credit extended by the RBI to banks for a very short term period, let us say overnight or 1 day maturity loan also. Bank rate is the rate at which the RBI is lending to banks, but for a longer period of time. Yeah. So next what we have is open market operation. It involves purchase and sale of government securities, for example, T-bills or treasury bills, right? So when the RBI buys these T-bills, it is necessarily so when RBI is buying T-bills from the people, I'm sorry, yeah. So it is basically using treasury bills purchase and sale to control the to control the money supply within the economy. Yeah. So next what we have, next tool that is available for the control of monetary policy by the RBI is the statutory liquidity ratio, right? So this is a percentage of total total deposits, which every bank is required to keep with itself in the form of certain securities like treasury bills, in the form of gold or cash. Yeah, Piyush, I think your question will be answered here. Cash reserve ratio. So all banks are required to maintain a certain portion of the total deposits in the form of only cash. Only cash with the RBI. This CRR is kept with the RBI, SLR the banks are maintaining with themselves. Of course, Arpan, if it becomes very risky if the banks are allowed to give 100% of their total deposits as loans, right? SLR is maintained with banks because at any point in time, these demand deposits which are existing, let us say in your saving accounts, can be demanded back by the investor, by the customer. CRR is cash reserve ratio. And it is calculated on it is 4% as of now, 4% of the total deposits. Have I answered your question? Right. So moving on, RBI is also doing certain selective credit control. It dictates to banks for particular sectors what kind of interest rates can be charged. For example, in the case of agriculture, the interest rates are usually charged lower as compared to other sectors. So marginal standing facility is something which was started by RBI in 2011. It is similar to repo rate itself, right? So now we come to repo rate. This is the most important rate as far as monetary policy controlled by RBI is concerned. It is also known as the policy rate, right? So it is a rate of interest that RBI charges banks for short-term lending against SLR securities, right? So there is a limit of minimum of 5 crores that the bank can borrow from the RBI. Current repo rate, this has been revised. This is now 7.75, right? It was revised recently. Reverse repo rate, as the name suggests, is exactly opposite to what repo rate is. Basis point is nothing but (25) basis point cut means 0.25% reduction. So I think this is also covered in this particular line, right? So 100 basis points represent 1 percentage point, right? 1 percentage point is divided into 100 basis points. Yeah, so reverse repo rate is the rate of interest which RBI pays to banks for accepting short-term deposits, right? As a rule, reverse repo rate is fixed at 1 percentage point below the repo rate. Before we move on, so we understood that a repo rate is a rate that the RBI is charging to banks for short-term lending. When RBI increases this repo rate, right, so naturally the banks have to give more interest to the RBI. So its cost of funding, the cost of funds for individual banks also increases when the interest rate increases, right? So naturally, when the cost is increasing, it is expected that banks will themselves increase the rate of interest which they are charging from individuals as well. So when RBI wants to control inflation, let us say, it will increase the repo rate. As a consequence, the interest rates within the economy charged by the banks will increase. As a result of that, the number of loans, which is the demand for credit, will fall, right? And the businesses will slow down. So that is why inflation is controlled. Right? So there are certain non-banking financial institutions also within the financial sector of our economy. These can be categorized under organized and unorganized. Development bank we have already covered. There are certain specialized institutions like LIC, life insurance, right? GIC, general insurance, and there are certain unorganized sector as well. Urban repo rate is the interest rate which the RBI is charging from commercial banks for giving short-term loans. Reverse repo rate is exactly opposite to that. When RBI wants to borrow certain short-term funds from commercial banks, that is the interest rate. See, there are situations, right? There are certain situations when there will be assets and liabilities mismatch for RBI also, and RBI is also prone to that. So that is why RBI might borrow from commercial banks. Otherwise, this is an instrument which is less used. Right? Moving on. So we have unorganized non-banking financial institutions which can be related to loan companies, hire purchase and financing companies as well. No, Varun, RBI in itself is not investing. However, the government, the RBI might issue instructions to various banks to provide social welfare. But however, RBI itself does not invest. The various services which are provided by NFCs, of course, are loans, credit facilities, investments, and trading in money market instruments. Important difference is NBFCs are not allowed to take deposits which are demand based. Demand based deposits they are not allowed to take. They are also providing advisory services in the case of merger and Kinsuk. Demand based deposit is like your saving bank account. You can put money in it and you can take out money at any point in time depending on your demand of money. Right? So these are the kind of accounts that NBFCs are not allowed to take. Yeah, so now what is happening? These are certain emerging trends which we see in banking sector. We have merchant banking solutions being provided by banks to various corporates who want to issue IPOs or FPOs, right? We have mutual funds as well. Banks are providing mutual fund services also, wherein they pool money from various investors and collectively that money is invested in the stock market or the bond market as well. Then we have retail banking also. What we are using ATMs. Internet banking is a something which is really picking up these days. And then we have venture capital funds wherein banks are financing certain individuals who want to start up their business. Again, Jan Dhan Yojana we talk is a very relevant current topic. So it was the basic idea between Jan Dhan Yojana is financial inclusion, right? So it wants to extend to provide bank accounts for people who are yet to have these accounts. So right now this figure is around 11 crores, 11 crores in January. So these are the basic, yeah, yeah, Pratik, 11.9. So it is providing a zero balance accounts with 1 lakh accident insurance and 5,000 overdraft facility is also made available for people who have opened accounts under Jan Dhan Yojana. RBI is only providing a regulatory role as far as Jan Dhan Yojana is concerned. It is only directing banks related to this scheme. No specific role that RBI has. Nitin, I'm not sure I understand your question. Okay, so many questions. Okay. Uh, yes, of course, providing accidental insurance, it makes it different from no-frills account that we discussed earlier also. Obviously, it will be a great help for the economy because earlier the amount of savings which were there, which these people had saved, it was lying in their houses. Now this amount has come into the economy, which is available to banks for giving credit, right? So that is how it will help the economy, Akshay. Yeah. Okay. The overdraft concept, as far as the Jan Dhan Yojana is concerned, so the account and the transactions made by this account, made under this account. Okay, guys, stop for a minute. Let me answer questions one by one, please. Yeah. So overdraft concept. So even if you have zero balance in your particular account, you can. Just a minute. Okay. I'm sorry. Yeah. As far as overdraft concept under Jan Dhan Yojana is concerned, when a bank account has been opened under this scheme, the various transactions will be studied, will be analyzed for the past 6 months. Then, if the bankers are sure that a minimum amount of money is always maintained in that particular account, so a 5,000 rupee additional credit sort of can be is given as far as overdraft is concerned. Okay, what is PE? Yes, Nitin, it can be included as part of diversification. Next question, what we have is uh, RBI itself is a very autonomous body. However, certain influence is obviously uh, exerted by the government also. For example, we recently had our finance minister was constantly talking about RBI needs to cut down its rates. So that is how a sort of moral pressure or media pressure is created on RBI itself. The industry is also constantly providing was putting pressure on RBI to reduce its rates. However, officially speaking, formally speaking, government is cannot officially interfere in monetary policy. That is entirely RBI's field of work. Right, guys, we'll move on now. Yeah, so there is a high prevalence of technology being used within our banking. This is done to increase efficiency, obviously, profitability and productivity. There are higher level of superior customer services which are being provided. This is mainly due to the coming in of private banks and increasing competition in the economy. Real-time transaction processing has been included through IMPS, right? So this is something that you need to read about a little more. Improved management. NPA is non-performing assets, so these are also being efficiently handled. Transaction costs are continuously coming down for banks as they use more and more technology, especially related to information technology. Yes, Akshay, big data can be used for better financial analysis. NPA Kinsuk is a non-performing asset. Now, technically, NPA is an asset is declared an NPA if it fails to uh, pay back its interest or an EMI for 90 days. 90 days after the payment is due, right? Of course, there are downsides to using more and more technology also. It has rendered the domestic system or domestic economy vulnerable to international shocks. Right, so what we saw in 2008-2009 financial crisis, the crisis started in USA, it slowly spread to Europe, and then it affected India's economy as well. So we saw for a couple of years the economic growth was depressed. Right, these are the various ways where how technology is being used in the monetary system. No, subprime crisis was not related to use of technology. However, excessive use of technology sort of makes interrelationships between banks in USA and across the world, right? So technology helped. Yes, RTGS is used for greater amounts greater than 2 lakh rupees. NEFT is for lower amounts. Yeah, so we also have a proliferation of mobile banking. Recently, a new product was launched. A new product was launched by Vodafone known as M-Pesa. I'm sure you must have seen ads for this, right? This is in collaboration with ICICI Bank and Vodafone. Yeah. So now we come to try and understand. M-Pesa is mobile. Yeah, Airtel Money is similar to M-Pesa ji. And M-Pesa is a service which is provided by Vodafone to its customers, wherein they can put certain amount of money in their mobile accounts, right? And they can even use it to transfer money to other people. Yeah, this is something like e-wallets, rather M-wallets. So insurance sector is governed under the IRDA Act, right, and the Insurance Act of 1938. Private participation was allowed in the insurance sector in India in 1999. So right, what are the various functions that an insurance is providing? Obviously, it is minimizing risk from losses. For example, if you have a car insurance, yeah, we'll cover that in some time. Yeah, so it is trying to minimize risk from losses. So if you have a car accident, your car insurance is covering for the damage, right? Larger risks it is providing with small capital payment investments. So when you put in small premium annually, it is covering larger risks. It is a tool of investment also. So if there is a highly developed insurance market within an economy, it becomes an attractive destination for FDI and foreign exchange. So as far as the debate on FDI in insurance is concerned, now the currently FDI was allowed at earlier FDI limit was allowed at 26%, right? And it is proposed to be increased to 49%. However, in order to increase this, the acts that we spoke about earlier, these need to be changed. IRDA Act needs to be changed, right? Yeah. Now ordinance has been passed, so it's basically been done to 49%. The act needs to be changed. For that purpose, the parliament had to vote and change this act, right? So earlier, of course, the UPA government which was there, it its coalition partners were not really allowing it to be passed. Right now, also the NDA government wants to pass it, but it does not enjoy a majority in the Rajya Sabha. So that is why it had to take the ordinance route and not get it passed by the in the parliament itself. Of course, when the insurance, when the FDI limit in insurance is increased, the we'll have a larger number of foreign investments, which is generally good for the economy, right? So moving on with the lecture. Yeah, so why is it facing opposition? Is again, first of all, it is a political. There are certain political reasons. Our opposition parties oppose just for the heck of opposing, of course. And then there is another skepticism: is that insurance business as such is a highly leveraged business. That is, a lot of public money is involved. So if there is greater participation of foreign companies, then the capital owned by the Indian investors, that is sort of put at a risk. If a foreign company fails in its country of origin, then the money that is owned, that money of Indian citizens also faces a certain risk. Pratik, ordinance can be passed again and again by the government. Yeah. So these are the various types of insurances that we see in our country. An ordinance is as good as a law. Okay. Although it ideally should be converted by the law, but converted into a law. However, ordinance is as good as a law. Right? So this is something that we've already covered. Any number of times the Prime Minister wants it to be passed, or the Cabinet wants it to be passed, it can be passed. Yeah, so moving on to the Indian capital market. Capital market is basically dealing with long-term capital, long-term funds, right? Demands from industrial, service sector, government, supply, or the money which is actually lent out. So it comes from individuals, corporates, banks, and other financial institutions. Right, we've already seen these developmental financial institutions. These are certain financial intermediaries which are bringing together investors and savers, right? First of all, we'll cover these financial intermediaries. Mutual funds we've already discussed. It pools the money of investors which are scattered, right? This money is then managed by a professional money manager and invested in stocks or bonds or wherever. Right? It is basically aimed at promoting saving and mobilizing funds to invest in stock and bond market. So these functions of mutual funds are all regulated by SEBI. All mutual funds have to be registered with SEBI as such. Kinsuk, bonds are instruments which are used by companies or governments to raise money, right? So and companies or government, whoever is issuing the bonds, have to pay certain interests. The maturity period of these bonds are fixed. Let us say 10 years. No, it is actually opposite to share. Share represents equity or ownership. Bonds is a sort of debt. Okay, bond is a type of debt. Equity or share represent the ownership of a person. Right? There are other financial intermediaries known as merchant bankers. They also underwrite new issues, undertake syndication of credit. That is, if more than one bank comes together to finance a particular project, that is known as syndication, right? And they provide financial advisories as well. Again, regulated by SEBI and RBI. Next topic for us is the stock markets. We'll try to get a basic understanding what exactly is the stock market and how exactly is it functioning, and what is the use of the stock market in a country. So the various types of companies which exist in India are, and which are registered under different acts or laws of the government are: first is companies itself. These can be public, right, and privately owned. For example, owned by the government, PSUs, and it can be privately owned as well. There are companies which can be partnerships, wherein there are more than one owners, and there are sole proprietorship, where there is just one owner. Yeah. So companies need financing at a very high scale. For example, if a company wants to set up a power plant, so it needs a lot of funds, right? So there are two ways how these companies can raise funds: debt market, that is through loans by banks, or by issuing bonds, right? What we saw earlier. Or it can also raise funds with the use of equity market. So it can issue certain shares of ownership to people and raise funds or money from the market to finance its projects. Piyush, mostly the interest rates are fixed. Issuing Kinsuk, these bonds can be issued to individual investors. There are certain companies like LIC which might also buy these bonds, and other private companies also might buy these bonds. Piyush, there is no relationship between the interest rates as far as debt market is concerned and the bank rate. Kinsuk, I am not able to understand your question. Can you restate? Yeah. So we'll talk about bonds in the debt market, as far as the debt market of a country is concerned, right? So there are two aspects. There is face value of a bond, that is the amount the buyer agrees to lend to the issuer, that is a company which is, or the government which is seeking to raise funds from the market. So the price value, yeah, exactly. So face value is basically the price that the uh, of the bond, right? And then what we have is the maturity date. It is a date when the funds are paid back to the lender, right? Paid back to the lender, which also includes the interest that the lender would earn for providing money to the issuer. Kinsuk, in case of a bond, you have to return the money as well as the interest. In case of a share ownership, you don't really have to return any money. The owner would earn through the increase in the share price or through dividends, right? Yeah. So if the issuer fails to pay back the loan, then of course the issuer is considered is declared bankrupt, right? And various other legal uh, processes can be started against the issuer. Right, then what we have is the maturity date, the date at which the all the funds are paid back. This includes the principal amount as well as the interest amount as well. So we'll see one by one what are certain terms within the equity market. So first is a stock. Stock is a certificate that certifies ownership. So equity and stock are the same thing. We've already discussed equity, so this is very simple now. Ownership of a certain portion of a firm. Sorry. So when a firm issues new shares of stock, it does not add to its debt. Instead, it is bringing in additional owners who supply it with more and more funds. Yeah, that's exactly what you are adding owners who are providing the company with additional funds as well. So, various stockholder meetings are organized in terms of annual general meetings by these companies, right? So, wherein the stockholders vote, in fact, to select the management of the firm. So, the CMD and various directors in the board of directors of publicly listed companies are actually voted by the stockholders themselves. So, they are exercising their ownership through voting. Again, here we see again, they do not promise a fixed annual payment. Return depend on the company's performance. So, if the profits are high, the firm may pay dividends. So, dividend is paid or declared by a company on the basis of. Yeah, I'll just do that. So dividends is paid on the basis of number of shares that I am holding in a company. For example, if I have 10 shares in Reliance and it would declare rupees 1 as the dividend, so I will get 10 rupees, right? Now, as far as your question is concerned, Kinsuk, PSUs are being owned. Government has ownership of PSUs up to the extent of 80% and sometimes even 100% as well, right? So when a PSU is declaring dividend, it has to pay dividend to the ownership, which is mostly in case of PSUs owned by the government itself. Yeah, so certain other terms related to stock market. Of course, first is the bull market. A bull market is a market which is seeing a continuous rise, right? So, for example, these days our stock exchange is rising, so the market is bullish. Bullish is an optimistic outlook on the market or a company, right? So, when investors are optimistic that the the stock exchange would be rising, the Sensex would be rising, that mood or that condition is known as bullish. Yeah, so opposite of bull is bear as far as stock exchanges are concerned. So bear market is a market which is dropping, going down. Bearish is a sentiment or market mood which is pessimistic with regard to the market as a whole or one particular stock. Right? Another term that is relevant to the equity market or stock market is a blue chip stock. These are companies which are very reliable, have been performing very well financially, and their share has been performing very well as far as the share prices is concerned. These are reliable companies and these are large companies, collectively known as blue chip stock. Closing price. Closing price, of course, whenever the market closes for the day, the price at which a particular stock or share was trading is known as the closing price. Yes, of course, Kinsuk, when you see the the closing price obviously depends on the demand and supply demand of a particular share. If the demand is high, the price will rise. So it will vary day to day on a day-to-day basis. Right. So when an IPO is given, when an IPO is released or an FPO is released, the price at which this particular share is bought at that time, FPO is further on public offer. Further public offer. IPO is initial public offer. Right? Yeah. IPO, FPO is after IPO, yes. So the par value is the price at which a new company stock is issued in terms of an FPO or an IPO, right? This is the price at which which exists in the primary market as such. Then market value is the price of a particular stock or a share when it is being traded in the secondary market, right? So that price depends on the demand supply dynamics. Now let us, for example, you expect that Reliance's financial results would be very good, right? So demand for Reliance's share at any point in time would start increasing. The demand would be very high. So when the demand is high, obviously the price will also of Reliance's share would also go high, right? Okay. Par value, Piyush, it is decided by companies. It is calculated on the basis of the financial results that the company has given. It is also calculated on the basis of market sentiments existing at that point in time. It's a very complex calculation. usually done by merchant bankers. Base price, I'm not sure. What is it related to? I'm sorry, Piyush, I'm not aware what base price is with relation to shares. Yes, exactly, Pratik. Company can raise fund only when? Only through an IPO. Of course, FPO is also used to raise funds only. Yeah. So shareholders only, yes, shareholders only gain. But you must realize that the company itself is also the major shareholder as far as shares are concerned, right? So moving on, moving on to initial public offer. We've already discussed this. It's a new offer of a company share to the public in the country's capital market, right? Shares are usually initially offered at a discounted price. Various methods are used, which are book building, fixed price method, or mixture of both. This is how the par value of a share is determined. These are the various methods by which it is done. Okay, mutual funds also we've already discussed. These are investment companies that are pooling money from investors, right? These are two types of mutual funds, open-ended and close-ended. Yeah, moving on to another instrument, that is a derivative. These are instruments or financial instruments whose value is derived from the price of. Mutual fund, Kinsuk, is a type of company which is investing your money and other people's money in shares, right? Right. So these are commodities whose value is derived from the price of some underlying asset. This underlying asset can be bullion, that is gold or silver. It can be any currency, stock market index, etc. Mutual fund is not exactly a tool. Mutual fund is a company, right? Wherein it takes money from various investors and invests in the stock market, right? Yeah. Derivatives, I'll just repeat again. There are some underlying asset, for example, yeah. So there are some underlying asset, for example, bullion. It might be some commodities also, like like uh, copper, the metal, or cotton, wheat, etc. These are some underlying assets on the basis of which the these commodities are traded. Right. I just answer your question. Just a minute. Of course. Uh, Now we talk about the Sensex, or it is a short form of sensitive index. It is taking into account stocks of 30 companies, right? Base value of Sensex, it is a relative measure. It is just an index, right? It is taken as 100, the value which existed in, right, and base year of BSE Sensex is considered as 70, right, 78 and 79. Yeah, so where were we? Yeah, so base year for Sensex is considered to be as 78, 79. It is just a relative measure. The kind of prices which existed in this year, the prices currently are calculated relevant to the prices which existed in this year, right? So your question as far as the Kinsuk, base year, as I said earlier, is the year when the prices of particular stocks are fixed, and then the current prices are calculated on the basis of the prices existing in the base year. So, okay, your question, prices of 30 stocks. No, the stocks within the Sensex keep on changing. They do not remain same. So initially, yeah. So as far as base year for GDP which was changed, it is something related but different. It was changed from 2004, 2005 to 2011 and 12, right? So that is also a measure which is so that is a yeah. So the base year has been changed for as far as GDP calculation is concerned from 2004, 2005 to 2011, 12, right? Kinsuk, no, base year exists only for the stock exchange and not for individual companies. And it's not necessary that Coal India will be included in the Sensex as far as these 30 companies are concerned. Right, guys, I think we should move on. It's already almost out of time. Yeah, so Sensex itself, it's a market index. Yeah, it is trying to capture the price movement. What are the various utilities? It helps us to recognize the broad trends in the market. So now, recently we've seen a huge growth as far as Sensex is concerned. So the market as such is considered to be bullish as of now. Right? So investors can use this index to invest in rationally among various stocks. Right? Analysts are using these indices to predict the future of the market. So these are also functioning as a status report on the general economy. So when the index is rising, the economy itself is considered to be growing. So these are various examples of various different important inputs, indices in different countries. The most important, of course, are the ones in USA. So these are various functionaries which exist in the stock market. Stock exchanges, of course, we have National Stock Exchange, Bombay Stock Exchange, etc. There are certain financial brokers or stock brokers which invest in the stock market on your own behalf. Registrar and depositories, these are certain regulatory bodies which regulate the functioning of the stock market. And then, of course, we have the principal regulator or the primary regulator, which is the SEBI. Sensex and Nifty as well, these are stock exchanges only. They can be I'm not sure. I think they are different. They deal with certain common stocks also, and there are certain different stocks which these exchanges are holding. Right. So, how are these stocks selected to be included in the in any index? Right. There are certain criteria which are deciding factor is the market capitalization of a particular company. That is its share price into its number of shares which are released in the market. Right. Industry representation and the history of the company after it is being listed. So as we discussed earlier, why do stock prices rise if there is a news about company? Yeah, continuity. As far as continuity criteria is concerned, how far has the company being operational in the market, right? Right. So stock prices rise if there is any news of company bagging a huge contract or getting into new business. So that is how stock prices will rise. News about the country. So, for example, since the time the NDA government has formed, the stock prices have continuously increased because we know for now that the country has a majority government, and that is an advantage. Exchange rate regime, what are the various uh, dynamics of exchange rate that are existing, and of course the demand and supply for the stock that we've already discussed. No, of course, news about company includes the performance of the company as well, or sales of the company, profits of the company. These are included in the news about the company. However, now we see that the stock market is slightly volatile. Sometimes it rises 500 points and falls also 3 or 400 points. This is mainly due to there are internationalization and integration of Indian market with the world market. So there are a lot of FII, foreign institutional investors, which are investing in our country, right? So whenever they see that Indian economy is performing well, these FIIs come in and invest our stock market, and the stock market rises. So whenever there is a bad news which is there as far as the economy is concerned, these FIIs take their money out and the stock market falls, right? It is also dependent on the exchange rate regime also. Yeah, so market capitalization, as we discussed earlier, is the share price into the number of shares that a company has issued in the market. So on the basis of this, there are three type of companies: large cap, middle cap, and small cap companies. Yeah, so these are certain benefits of investing in shares. There possibility of high returns, easy liquidity. These shares can be sold at any point in time. No, market capitalization, Kinsuk, is actually calculated in terms of rupees. Yeah. So you have a lot of tax benefits also. There are new scheme known as ELSS, Equity Linked Saving Scheme, right? You earn income from dividends also. But of course, if you are earning, then you can expect to bear losses as well. Right? So participatory notes is a type of instrument which can be used by investors based out of India usually. They use P notes by and invest in Indian stock markets. Right? However, the problem with P notes is that the Indian government does not get to know the uh, identity of the investor. So that is a problem. Right, guys, that is the end of the presentation. Any questions? See, as far as the topic that we've covered today, uh, you can expect questions which are mainly from current affairs, right? As I said earlier, that the idea of this presentation is get to tell you the basic, very fundamentals of these issues, right? Which will enable you to follow current affairs effectively and read the newspaper with full understanding, right? So you can expect questions more on the current affairs. Yeah, Piyush, go ahead. Piyush, I think we should limit our questions only to the presentation, right? I think general topics related to economy, economic growth, right? These are topics which you'll be expected to know about. Right? Any other question, guys? All right, guys. Thank you so much.